being a homeowner comes with its own set of advantages. It's more than just having a roof over your head, it's about transforming a space into your own, with the freedom to design, alter, and enhance as you see fit. As you gradually pay off your mortgage, you're simultaneously building up equity. Plus, you get the financial perk of deducting expenses like mortgage interest and property taxes from your annual tax bill, ultimately reducing your overall tax expenses. For those who venture into real estate investment, the benefits extend even further than those of standard homeownership. Investing in real estate offers a variety of advantages, including a consistent revenue stream, mortgage payment coverage through tenant rents, accumulation of equity, generation of cash flow, diversification of your investment portfolio, protection against inflation, substantial tax advantages. Although paying real estate taxes might not be appealing, both homeowners and investors have the opportunity to leverage numerous tax deductions, effectively minimizing their tax liability. Navigating the intricate world of tax legislation, which is subject to frequent changes, can be daunting. To maximize your tax benefits, it's advisable to seek guidance from a reputable tax accountant or CPA. Even so, possessing a fundamental grasp of the tax implications associated with property ownership or investment can be incredibly beneficial. Here's a primer on real estate taxes to kickstart your journey. Taxes and deductions for property owners. As a property owner, you're responsible for two main categories of taxes related to your real estate. 1. Property taxes, often referred to as real estate taxes. 2. Capital gains taxes. Before we delve deeper into this topic, a quick reminder: if you're finding this content valuable and want to stay updated with more insights like this, don't forget to subscribe to our channel. This way, you'll always be in the loop with the latest in real estate and taxation. Now, let's continue our exploration. Property taxes. Owning a home invariably brings property taxes into the equation. These taxes, levied by your local government, fund various community services such as emergency response, libraries, educational institutions, and road maintenance. These taxes are either paid annually directly to your local tax office or incorporated into your monthly mortgage payments. The amount you pay is determined by the assessed value of your land and any structures on it. Ownership of the property means a commitment to these taxes. They don't cease when you finish paying off your mortgage or if the property ceases to be your primary residence. As long as the property is registered in your name, you're responsible for the taxes. Remember, property tax rates are subject to change. Your bill may fluctuate if there's a reassessment of your property's value or if there are adjustments in the local tax rate. Reducing your property tax bill. Research suggests that between 30% and 60% of U.S. properties are overassessed, potentially leading to higher tax payments. If you suspect an error in your property's assessed value, you have the right to challenge it. Furthermore, you might decrease your tax burden through various deductions and exemptions available for elderly homeowners, veterans and their surviving spouses, individuals with disabilities, owners of agricultural properties. Additionally, many states offer homestead exemptions, which shield a portion of your home's value from property taxes. Another potential avenue for savings is paying your tax bill in advance, which can sometimes yield a discount. It's advisable to contact your local tax office to explore the deductions, exemptions, and potential discounts applicable in your region. Capital gains taxes. Homeowners and real estate investors may also face capital gains tax. This tax becomes relevant when the sale of your property yields a profit exceeding its original purchase cost and associated expenses. To calculate net proceeds, subtract any sale-related expenses from the selling price. The cost basis includes the initial purchase price of the property, expenses incurred during the purchase process, such as mortgage application fees, appraisal fees, home inspection costs, transfer taxes, etc. Costs of significant upgrades, like roof replacements or bathroom additions. Capital gains tax is levied on the profit, the difference between net proceeds and cost basis, not on the entire selling price or the net proceeds. A negative result indicates a loss, while a positive number suggests a profit, potentially subject to capital gains tax. Exclusions for capital gains tax. Many homeowners can exclude up to $250,000 of capital gains, or $500,000 for married couples filing jointly, from the sale of their primary residence. However, certain conditions apply. The property must be your primary home. You should have lived there for at least 2 out of the past 5 years, non-consecutive years are acceptable. You must have owned the house for a minimum of 2 out of the past 5 years. Additionally, Partial exclusions may be available under specific circumstances like job relocation, medical reasons, or unforeseen events like death, divorce, or natural disasters. Capital gains tax rates, short-term and long-term. Gains exceeding the exclusion limit, or those not qualifying for exclusion, are reported on Schedule D, Form 1040. The tax rate depends on the duration of ownership. Short-term gains, property owned for less than a year, are taxed as ordinary income. Long-term gains, property owned for more than a year, usually benefit from lower tax rates. High-income taxpayers may also face a 3.8% net investment income tax. Deductions for homeowners. Beyond property tax reductions, homeowners can also reduce their income tax through these deductions. State and local taxes, SALT deduction, deduct up to $10,000, $5,000 for married filing separately, for combined property taxes and either state and local income or sales taxes. Mortgage interest. Deduct interest on mortgage debt up to $750,000, $375,000 if married filing separately, for a first and/or second home. For homes bought before December 15, 2017, the limit is $1 million, $500,000 if married filing separately. Taxes and deductions for real estate investors. Similar to homeowners, those who invest in real estate are also subject to property-related taxes but can avail themselves of various tax benefits. Typically, real estate investors encounter three types of taxes. Property taxes. Investment properties are often valued based on their highest and best use, which refers to the most lucrative way the property can be used within legal and physical limits and financial viability. The assessed value is then multiplied by the local tax rate to calculate the tax owed. Notably, commercial real estate usually attracts a higher tax rate than residential properties. Additionally, some areas levy taxes on business personal property, encompassing items like equipment, fixtures, and furniture that contribute to your revenue generation. For properties in these jurisdictions, it's mandatory to submit a business property statement, or its equivalent, annually. An assessor then evaluates the total worth of your personal property, and the tax office issues the bill accordingly. 1. Real estate income taxes. Income derived from property rentals is taxed as ordinary income. This includes all rental revenue minus allowable deductions, which you report using Schedule E, Form 1040, Supplemental Income and Loss. 2. Capital gains taxes. Selling an investment property for more than its purchase price incurs capital gains tax. Unlike homeowners, real estate investors usually can't claim the $250,000, $500,000 for married couples filing jointly capital gains exclusion since the property isn't their primary residence. The nature of the capital gains tax depends on how long you owned the property. Sales within a year of purchase, such as house flips, are subject to short-term capital gains tax, while holdings kept for over a year are taxed at the more favorable long-term rate. Tax deductions for real estate investors. Real estate investors face taxes on their properties, income, and capital gains. However, numerous deductions can significantly reduce your tax obligations. Investment property owners can deduct a wider range of expenses than homeowners. These include interest paid on mortgages, property taxes, insurance costs, operational expenses, maintenance and repair costs. These expenses are deductible in the year they are incurred and must be reported on a Schedule E tax form along with any rental income. Depreciation. Another deduction for real estate investors is the depreciation of the property's purchase and improvement costs. Instead of a single large deduction upon acquisition, these costs are depreciated over the property's useful life. The IRS stipulates 4 criteria for property depreciation: ownership of the property, usage in a business or income-producing activity, a definite useful life, meaning it deteriorates, decays, becomes outdated or loses value naturally, expected lifespan of more than a year. Properties cannot be depreciated if they are bought and sold within the same year. Additionally, land is not depreciable as it doesn't deteriorate or become obsolete. The value of the land must be deducted from your total cost to calculate the depreciable amount. Currently, depreciation is spread over 27.5 years, equating to 3.636% of the cost basis annually. This continues for up to 27.5 years or until the property is no longer in service, whichever occurs first. Depreciation recapture on rental property. When selling a rental property, the depreciation you've claimed affects your tax liability. Depreciation deductions lower your property's cost basis, influencing the calculated gain or loss on sale. The IRS will recapture some of the depreciation deductions through depreciation recapture taxes, which are based on your ordinary income tax rate and capped at 25%. Form 4797 is used to report this. If the property is sold at a loss and you've owned it for over a year, depreciation recapture doesn't apply, and the loss can offset your taxes. You can also carry back the loss to offset income from the previous 2 years or carry it forward for up to 20 years. Qualified business income on rental property. The qualified business income (QBI) deduction is another potential deduction for rental property owners. It allows a deduction of either 20% of qualified business income plus 20% of certain dividends or 20% of taxable income minus net capital gain. IRS Notice 2019-07 offers a safe harbor for rental real estate, allowing owners to claim this deduction if they spend at least 250 hours per year managing the property and maintaining detailed records. However, vacation rentals and triple net leases do not qualify. 1031 exchanges. Section 1031 exchanges enable deferral of capital gains taxes when selling an investment property. It involves swapping one investment property for another, using the proceeds from the sale. To qualify, the replacement property must be similar and used in business or investment. Any boot received, which includes non-like-kind property or benefits, is taxable in the year of the exchange. The new property must be identified within 45 days and acquired within 180 days of the sale of the original property. Although taxes are deferred, these exchanges must be reported on Form 8824. How REITs are taxed. Another avenue for real estate investment is through real estate investment trusts, REITs. These entities enable individuals to collectively invest in a diverse array of properties or other real estate-related assets. As a REIT shareholder, you will receive an annual 1099 DIV form, which details the dividends received. These dividends fall into 3 categories. 1. Ordinary income dividends, typically taxed at your regular income tax rate. 2. Capital gains distributions, generally taxed as long-term gains, irrespective of the duration of your investment in the REIT. 3. Return of capital payments. These are not taxed as they are regarded as a reimbursement of your invested capital. Opportunity zones. The 2017 Tax Cuts and Jobs Act introduced opportunity zones, aimed at stimulating economic growth and job creation in underdeveloped areas by offering tax incentives to investors. Investments in a Qualified Opportunity Fund, QOF, offer 3 tax benefits. Deferral of capital gains. Taxes on previous gains can be deferred when reinvested into a QOF, up until the sale or exchange of the QOF, or until December 31, 2026, whichever is earlier. Reduction in capital gains. If gains are invested in a QOF for a minimum of 5 years, the basis of the original investment is increased by 10%. This increase goes up to 15% for investments held for at least 7 years. Exclusion of capital gains. Profits from the QOF are exempt from taxes if the investment is maintained for at least 10 years. Find a good tax professional. While tax matters for homeowners tend to be more straightforward, the tax landscape for real estate investors is considerably more complex. The taxes discussed here represent the typical ones encountered by real estate investors. However, depending on individual circumstances, there may be additional taxes to pay or extra tax advantages available. Tax regulations are intricate and subject to frequent updates. Unless you're exceptionally well versed in real estate tax law, a rarity, it's advisable to collaborate with an expert. Engaging a reputable tax accountant or CPA is crucial in managing the financial aspects of purchasing, operating, and selling your investment properties. Their expertise ensures you receive the most beneficial tax treatment and helps prevent unexpected complications when filing your taxes. And there you have it, a comprehensive look at how to navigate the world of taxes as a homeowner or real estate investor. We've covered everything from property and capital gains taxes to the intricacies of REITs and opportunity zones. Remember, understanding these concepts is key to maximizing your savings and making the most of your real estate investments. If you found this information useful, you might also be interested in learning about common pitfalls in the real estate world. Avoiding mistakes is just as crucial as understanding tax nuances. So, why not continue your learning journey? Just click on the video appearing on the screen now to dive into real estate mistakes to avoid. Equip yourself with this knowledge to ensure your real estate ventures are as successful and hassle-free as possible. See you there.